Hello there. Happy New Year, everybody. And welcome to the Kluge Wealth Advisory Group Client Monthly Video for December 2025. In this month's video, we're going to cover off a number of things, including a couple of housekeeping items. We're going to touch on a monthly and annual portfolio review, a market review, as well as getting into touching on some portfolio changes and touching on our 2026 outlook. Now, there's quite a bit to cover here, so let's get right into it. Now, before we get into the meat of this month's video, there's a couple housekeeping items I want to touch on. The first was just to emphasize and communicate that we will be producing our usual tax package this year, and that because of filing deadlines for tax slips, that package will be coming out towards the end of March or in the very early opening days of April. Now, if you do have any questions between now and then, please reach out. We're happy to supply you with any information that you need or answer any questions you have on that. The second is that when we go into next month's video, we're going to do a little bit of a reintroduction of some of the team members here at Kluge Wealth Advisory Group. There's been a fair amount of professional development that's been happening under the surface, and I want to make sure that each and every one of you is up to date on what's been happening and how each team member's roles have been evolving. And of course, as I always say, if there's anything that you want to discuss in more general terms, please give me a shout. We are here to help. In terms of a market update for December, overall, we had a pretty dramatic month. There was a sharp correction into mid-month, followed by a rally into Christmas time. Always good to see that Santa Claus rally. The net result was that markets were pretty flat over the course of December, as we're videoing this here on December 30th. Now, looking more broadly, we see that bond markets were relatively stable, and that as expected, the Bank of Canada held its overnight lending rate, and the Federal Reserve cut its overnight lending rate by 0.25%. More broadly, commodities were pretty flat, but we did see a decline in the price of crude oil, which is always good for the gas pump. And we did see some headlines around a big move in silver, which has been catching a lot of attention here recently. However, that's some action under the surface. In the big picture, not a lot of movement on that front. The month of December for portfolios was topsy-turvy, just like the market. There was a drawdown into mid-month and then a rebound into year-end. The bottom line, however, is that investors continue to shy away from high-quality stocks with high relative strength, which hurts us a bit because we have a bias in the portfolio to companies with high profit margins, low debt, high growth, etc. And so when investors choose to sell those securities and chase stocks for a year-end rally, which they did in several sectors, that tends not to help us out very much. So I don't believe that this type of a rotation is a long-term thing. There's well-documented evidence that high-quality companies that are in long-term established uptrends do tend to do very well. However, that doesn't mean they do very well all the time. And if you have a period that stretches, say, from mid-November to mid-December like we had here, it is very possible that in the very short term that high-quality companies can underperform. So I don't think this is anything alarming. I think it's part of a normal rotation. And given the amount of topsy-turvy action that we saw this year with sharp drawdowns and big rebounds, we should expect this to happen, and that there are a lot of folks that are trying to get return into year end, and so they are looking for they're looking to get it any way they can. So bottom line is, it is likely going to be another down month. That will, of course, be in line with a lot of benchmarks we're following that describe various types of balanced portfolios. So not a lot of surprise there. Another note is, we did complete some tax loss selling. There wasn't a lot to do. Fortunately, we don't have many positions, or didn't have many positions that were in a loss that we didn't think had a good future in front of them. So where that opportunity existed, we took it. And of course, if you have any questions on any of this, I'm happy to get into more detail. Just pick up the phone, give us a call, book us on Calendly. We're here to talk. In this section of the video, I want to give each and every one of you a quick heads up on a portfolio management refinement that we're going to be implementing on January 1st. This refinement is a result of doing a very detailed portfolio evaluation about trading, sources of return, and potential efficiencies. We've really torn down what we've been doing here at the Kluge Wealth Advisory Group to make sure that we're doing the best job possible. I know things have been going pretty well here over the last 3 years. However, I'm always asking the question, where can we do better? And that's why we undertook this process of a detailed analysis to see if there was what we could do better and if it was feasible to do that. Now, the bottom line is that what we're going to be doing here is spending a little less time emphasizing individual stock picks and more time emphasizing using baskets of shares, such as ETFs, to emphasize sectors or subsectors, themes, factors, etc., that we want to emphasize in your portfolio. By using this basket approach, I think there's going to be three key benefits. First is it's going to very likely increase returns because it's reducing errors. One of the mistakes that this analysis found was where we would pick the right sector to invest in, but just pick the wrong stock. An example of that would be that we held John Deere, or Deere, earlier this year to represent the industrial machinery subsector. However, a better stock to pick, for example, would have been Caterpillar or Parker Hannifin. Now, because we own Deere, we did not own Deere or Parker Hannifin, and we missed out on the returns that we could have earned by owning that, or the returns that were available to just buying a basket of industrial machinery stocks. So if we can reduce our error rate, we will inherently increase returns. The second area where I think this refinement will make a positive benefit is in terms of tax efficiency. When you're using baskets of stocks, you tend to trade much less frequently. And if you trade less frequently, you'll have fewer tax realizations. And if you have fewer tax realizations, your capital gains tax bill will be lower. And so that will allow you to not only potentially earn more money, but also keep more of it. So I think there are two very, very large potential benefits that are important in this refinement. The third benefit really comes down to what I like to call advisor risk. Now, the bottom line is that many of you know that I did suffer a serious illness last year with my ruptured appendix. And if I was ever in a position where I was abducted by aliens again, I want to make sure that no matter what happens, that the team here is able to keep advice flowing, portfolios managed, and your future secure. So this, I believe, being a healthy 46-year-old, I believe this is a remote risk. However, this is something that I want to make sure that we're covering off. And in conjunction with the tax efficiency and the potential return improvements, I think it's something that is important that is helping to drive this refinement. We're thinking about the big picture. We're thinking about helping to manage all of the risks that you face. Now, in the next section of the video, I'm going to get into a couple of questions that I'm sure many of you may have. But if you do want to talk about this personally, again, very happy to. Reach out, give us a call, email, book a time on Calendly, and we're happy to go into detail and discuss this in a little bit more detail if you wish. Thank you very much, and we'll look forward to we'll talk about some of these other questions you may have in the next section. In this section of the video, I'm going to get into a little bit more detail on some questions that you may have. I can imagine you maybe have questions about how this would impact management fees, how this is a refinement and not a fundamental shift, and how this is going to provide more benefit. So let's get right into those. So then the first question of fees, what I can imagine is you would say, well, we're going to start using baskets of shares. Now those baskets are always going to have a product fee associated with them. And I'm going to have to say, yes, they will. However, what we also have to look at is at the portfolio level, what else have we done? And part of the process that we embarked on when looking at this portfolio analysis was we were looking for efficiencies. And what we mean by efficiencies in this context is, are there products that we're using that in and of themselves are good, but at a portfolio level don't justify the amount of fees they cost for the return they deliver to the portfolio? So, and the answer to that is that yes, that existed, and we have certainly gotten rid of those products. So at this point, we know that we are down to a very, very efficient portfolio, and even including the estimated fees the baskets will generate, I believe that fees will actually be lower going forward than they were, say, on September 30th of this year. Now, that's what we've modeled out, and this is something we're going to monitor going forward, but I believe it'll actually, because of the gains in efficiencies, you'll actually end up in a net better position. A second question that I imagine you may have is about why this is a refinement and not a fundamental shift to our underlying style. So in terms of managing money, there's two styles that you can engage in. You can engage in top-down management, or you can engage in bottom-up management. Now, for clarity, bottom-up management is just where you take a look at the virtues of each investment in and of themselves, and you put together a portfolio based on what appear to be good ideas. And this investment style has a lot of merit, and there are a lot of great fundamental bottom-up investment or stock pickers that are out there. The other way of managing assets is a style called top-down. Now in top down, you take a look at what is the environment, both now and expected, in terms of things like long-term demographic trends, inflation, the economy, interest rates, etc. And then you allocate to sectors that have historically done well under the conditions you expect. Now, both these styles are completely legitimate. I personally use a top-down style. And so when you use a top-down style, stocks are an output of allocating to sectors or sub-industries, not an exercise in and of themselves. So fundamentally what we're doing here is just saying that the process should stop at the sector level or at the industry level and not at the individual stock level. For instance, as opposed to saying that we want to own JP Morgan, Goldman Sachs, or Citigroup, which we currently do, we would simply stop at saying we want to own a ETF that covers all of the large US banks. So happy again to talk about this more, but hopefully that answers the question about why this is a refinement and not a fundamental shift. The final question that I imagine you may have would revolve around a little bit more, getting a little bit more detail about the expected improvements from this refinement. So when we take a look at the expected benefits from this refinement, one of the expected benefits is going to be the expectation that ultimately you will see a reduction in realized capital gains over the next few years. Now, this is not going to be instantaneous because we are not simply going to run headlong into this refinement. We are going to evolve into it over the next 1 to 2 years, depending on market conditions. However, in the longer term going forward, we do expect that you're going to see lower trading volumes in your portfolio and therefore lower realized gains and therefore lower capital gains tax bills. And I believe that if you ultimately have more money working for you longer at the rate of return that we've been generating, that you will ultimately have more money. And so I think that from a intermediate to long-term perspective, this is a huge positive because it's going to allow you to keep more money, defer tax, and ultimately allow you to grow your wealth faster. So looking at this tax efficiency, even by itself, to me, this looks like free money that we should be picking up. The other major benefit that I see from this change is just that it's going to it is very, very likely to reduce the error rate in the portfolio. Now, the key error that I find most frustrating and that some of you find most frustrating is where we pick the right sector to be in, but then we pick the wrong stock. And in our previous video introducing this refinement, we talked about John Deere versus Caterpillar or other industrial machinery shares. When you have a rising system like the stock market, errors have two costs. They have the cost of being wrong and the potential loss associated with that. And they also have an opportunity cost, right? You missed out on earning on something else that could have been going up. So as much as it is important to be right when you're an investor, it's also really important to be not to be wrong. And so what we want to do here is keep the opportunity to be right available, but reduce the frequency and cost of being wrong. And so in that way, although it's not guaranteed, it should produce a measurable increase in returns as we go forward. So when I take a look at the entire situation and say we can deliver potentially higher returns with lower tax, that to me seems like a very, very easy situation and a very easy decision when we're looking at this from the perspective of you, the client. So there are a couple of other things that we can get into here as well. Again, I also always want to emphasize that this is going to be a process and not an event. We're not simply going to sell off everything January 1 and reinvest. Markets may allow us to go quicker, they may allow us to go slower, but this is the direction we're going in because of these improvements that we can see both in terms of efficiency of return, but also just in terms of raw return itself. So again, as I have at the end of every single one of these questions, I just would invite you to give me a call if you have any questions, and we're happy to talk about things. Make sure you're up to speed and make sure you have a comfort and understanding of what we're doing, why we're doing it, and what the future does hopefully hold for everybody. Again, please give us a shout, and if there's anything you want to discuss, we're here for you. So over the course of December, there really was only one frequently asked question that we ran into on regularly, and that was just about an outlook for 2026. So the bottom line is that for the year of 2026, I'm fairly optimistic. I mean, we have a situation where the economy is doing well. It looks to be accelerating, at least in terms of the U.S., which will of course help Canada. Investor sentiment has been skeptical down to outright negative over the course of the last year, which is pretty interesting given the fact we did see positive returns again. We also see that the quantitative patterns and technical patterns are all supportive. And we do know that through various deregulatory and market-based measures that liquidity continues to rise. There's more money in the system, there's more oxygen available to help generate returns, so to speak. So I am overall optimistic. However, I always want to be upfront in saying that, look, we are at a time right now where volatility is heightened, and that there's always a wall of worry out there, right? First of all, it is the U.S. midterm election year. Now, that is historically has not produced great returns. However, it's also extremely rare that we see a correction like we did in April, preceding a U.S. midterm election year. So what is that going to do to the cycle? We don't know, but we do need to be aware that that it is a midterm election year, and make sure that we're being aware of that. There's also other worries out there, the AI bubble worry. There's concerns around what would happen if the Supreme Court overturned Trump's tariffs, et cetera, et cetera. And I did want to emphasize here is that even though we may have to go through a lot of volatility to get to that positive return, that just like we did in 2025, is that there's an old Wall Street saying, and that's basically is that bull markets climb a wall of worry. And that if you didn't have the worries, you wouldn't have investors who are afraid. And if they're afraid, they don't invest. And so if people aren't invested, it leaves upside. The biggest concern you have for a bull market is when the Federal Reserve or the central banks begin to restrict liquidity, and you see investors get quite optimistic. And we're nowhere near those two conditions. So although I do expect a bumpy year, I do expect things to be very positive as we climb this wall of worry, as we have from April. So looking forward, I think it's one of these situations where we don't want to take it too personally when it's up. We don't want to take it too personally when it's down. We're just going to keep our eyes firmly in the windshield and driving within the speed limit and making sure that that we're keeping our eye on the big picture, because that's really where the prize is. So I can, again, happy to get into more detail on any of this 2026 outlook or any of the things that we've talked about in this video. But again, bottom line is do expect a good year. Maybe bumpier than maybe we would have gotten used to back in the 2010s, but this seems to be the new reality of the 2020s, and we may as well embrace it. Thank you.